Have you ever stopped to think about the sort of invisible things that make our modern world work? Like really work? I mean, the companies building the critical stuff, the advanced materials that let a huge plane fly or, make a medical implant actually function inside someone, they often operate behind the scenes, but they're absolutely essential. So today we're doing a deep dive into one of these companies, ATI Inc. We're going to try and dissect the pros and cons of potentially investing in them. And look, you've given us some great source material to work with articles, research, your own notes. Our job now is to distill all that down for you, make it clear, make it useful.
Exactly. The goal here is really to cut through the noise, focus on what's genuinely important for understanding ATI. Where do they stand in the market? What factors could actually move the needle on their value? We want to equip you ultimately to decide if ATI fits with how you see things, your investment approach.
Okay, let's start right at the beginning then. What exactly is ATI Inc.? What kind of materials are we actually talking about?
Well, at its heart, ATI is a specialty materials company.
Mhm.
And I mean specialty. They engineer very advanced metals and components. Think things like super alloys, titanium alloys, specific kinds of specialty steels. This isn't the stuff you find down at the local hardware store, right? These materials are designed for extreme performance, high heat, immense pressure, corrosion resistance, really demanding environment.
Right, demanding environments. And it sounds like they're targeting specific markets where that performance is absolutely critical.
Precisely. And what's fascinating here is which markets. We're talking high-value sectors where failure just isn't an option. Aerospace and defense is the big one, obviously. Safety, mission success, it all relies on materials performing perfectly, but also medical, electronics, specialty energy. In all these areas, properties like, say, strength-to-weight ratio or heat resistance, they aren't just nice-to-haves. They're fundamental. That specialization gives them an edge. It's hard for others to just jump in and replicate what they do. It creates a barrier.
That makes sense. And I noticed in the sources there's been a deliberate shift, hasn't there? More focus on aerospace and defense, less on maybe commodity steel. Why is that important for someone looking at this?
Ah, yes, that's a really smart strategic move. It fundamentally changes their risk profile and their potential for higher margins. See, they used to have more exposure to those, let's say, more volatile, lower margin commodity markets. Steel can be very cyclical. By deliberately shifting focus and their capital towards aerospace and defense, they're moving into areas that tend to be, well, more stable. You get much longer contracts, often multi-year deals, and the margins are generally better because the products are so specialized. It offers more predictable revenue.
Okay, so that groundwork helps. Now let's unpack the recent wins, the positive side. They seem to have put up some strong numbers lately. What stands out financially?
Yeah, the recent Q2 2025 results, they really do paint a positive picture. And they underline that strategic shift we were just talking about. Sales came in at US $1.14 billion. That's up about 4% compared to the year before. But what's more impressive is the net income. That jumped significantly, went up to around $101 million from about $82 million the previous year. And that translates to earnings per share, or EPS, of roughly $0.76 GAAP. That's the standard accounting. Or even better, $0.74 on an adjusted basis. Compare that to maybe $0.60 a year ago. Solid growth.
Those are strong figures. And it looks like their margins, their operational efficiency is holding up well too?
Absolutely. Their adjusted EBITDA, that's, earnings before interest, taxes, depreciation, amortization, a key measure of operational cash flow. It came in at a really robust $208 million. That works out to 18.2% of sales, which is very healthy. And it's up about 14% year over year. For a company like ATI, an industrial manufacturer that needs a lot of capital investment, keeping an EBITDA margin like that, north of 18%, is a strong sign. Shows they're running efficiently, maybe have some pricing power.
And it looks like management's feeling pretty good about where things are headed, given the updated guidance for the full year.
They seem to be, yeah. And that's always an important signal, isn't it, what management themselves are saying? They've actually raised their full year 2025 guidance. They're now projecting adjusted EPS somewhere between $2.90 and $3.07. And free cash flow, the cash left over after running the business and investing in assets, they expect that to be between $270 and $350 million. Raising guidance like that, it signals real confidence.
What's really compelling there is how those numbers, especially the aerospace and defense growth, show that the demand is there, right, for their specific stuff. And that raised guidance, as you said, it's a strong vote of confidence from the leadership team. They seem sure about their strategy and execution.
Exactly. It suggests the strategy is working.
But it's not just the quarterly results. They've also locked in some big strategic deals, haven't they? Things that look like they provide stability for longer.
Yes, precisely. Those are really important. One huge one is the extended and expanded long-term agreement with Boeing for titanium. This isn't small potatoes. It covers Boeing's commercial planes, narrow body, wide body, and some of their other units too. And then there's the expansion down in South Carolina. That's backed by new long-term deals with both Airbus and Boeing for materials made right there.
Okay, so if we connect this to the bigger picture, these deals sound crucial.
Oh, absolutely crucial. They essentially lock in demand for years ahead. That's vital when you have to plan big investments in factories and equipment. It ties ATI much more deeply into that critical aerospace supply chain, gives them much better visibility on future revenue, makes things less lumpy.
Less lumpy, yeah. And it looks like the financial world is noticing their improving health, too. S&P upgraded their credit rating to BB, and they're aiming to keep debt levels manageable.
Right. Getting that credit rating upgrade to BB is a definite plus. It helps lower their borrowing costs potentially, makes it easier to get capital if they need it. And actively managing leverage, keeping debt below about 3 times their EBITDA, that reinforces the picture of financial discipline and strength, makes them look like a safer bet to lenders.
Okay, good foundation. Now, we have to look at the flip side, the risks. And, I mean, in an industry like this, capital-intensive, cyclical, there are always going to be significant headwinds to think about. First off, that cyclicality you mentioned in aerospace and defense. How big of a deal is that for ATI?
It's huge. Honestly, it's one of the biggest factors any investor needs to get their head around. Commercial aviation especially, it really moves with the global economy. Air travel slows down, fuel prices shoot up, recession hits, airlines push back orders, and ATI feels that pretty much immediately. Their materials are in those planes.
Yeah.
Defense spending has its own cycles too, often driven by politics. So yeah, even though these are high-value markets, they are definitely not immune to shocks. Demand ebbs and flows.
And what about the costs? Making these specialty metals can't be cheap. Are they squeezed by raw material prices? Nickel, titanium.
That's a constant pressure point. Always is for materials companies. Yes, they need costly inputs like nickel, titanium, cobalt sometimes. The key thing to watch isn't just that the prices of these things go up and down, they do. It's about ATI's ability to pass those costs on to their customers. How quickly, how fully. If they can't pass costs through effectively, those nice margins we talked about, they can get squeezed fast. It's a real test of their market power.
Okay, so input costs are one thing. What about competition? Are other companies or even other types of materials a threat?
Oh, for sure. Competition is always there. You've got other advanced materials suppliers fighting for the same contracts. Maybe they offer lower prices, or maybe they come up with a new material, a technological leap that could potentially replace what ATI makes. And you also have to consider the big customers themselves, the Boeings, the Airbuses. They might look at bringing some production in-house, vertical integration, or just push really hard on all their suppliers to cut costs. ATI constantly has to prove its value.
That pressure is constant. Now, this raises an important question about investment. ATI is capital intensive. You mentioned they're planning significant capital expenditure, maybe $260, $280 million. That's a lot of money tied up in plant and equipment. What's the risk if demand dips after they've committed all that cash?
That is a critical risk, absolutely. Spending that kind of money on new capacity or upgrades, it's done with an expectation of future orders, future demand. If that demand unexpectedly weakens, maybe due to a downturn, those big investments might not generate the returns they hoped for, or at least not as quickly. You could end up with underutilized factories, assets basically sitting idle, tying up capital, and dragging down overall profitability. It's the inherent risk in these long-cycle, heavy industries.
And debt. We said leverage is improving, but the sources note long-term debt is still significant. Total debt to equity is high. What does that mean practically?
Right, it's good they're managing it down, but you can't ignore the existing debt load. High debt means a chunk of their cash flow has to go towards servicing that debt, paying interest, paying back principal. If cash flow dips unexpectedly, say, during one of those cyclical downturns, it puts more strain on the company, reduces their financial flexibility. A high debt-to-equity ratio just means more of the company is financed by borrowing rather than owner's equity. Generally, that implies higher financial risk if things get tough.
So what does this all mean for how the stock is valued and how volatile it might be? The sources mentioned a forward PE ratio price to earnings in the mid-20s, maybe 25, 26x. How does that kind of valuation hold up when markets get choppy?
Yeah, that's where the wider economic picture really comes into play. A forward PE in the mid-20s, especially if you strip out any one-off items, it suggests the market is already pricing in a fair bit of future growth. Expectations are quite high. The risk is that in volatile times, maybe interest rates are rising sharply, inflation stays sticky, or there's just a broad market sell-off. Multiples like that often get hit harder. Investors tend to become more risk-averse, less willing to pay that premium for future growth when uncertainty is high. So yes, it can lead to higher stock price volatility for ATI compared to, say, a company with a lower valuation multiple.
And one last risk factor, their global footprint. Being a materials business means dealing internationally, right? What kind of geopolitical or trade risks do they face?
It's pretty significant, actually. The whole supply chain for advanced materials is global. You source raw materials globally. You sell to customers globally. So ATI is exposed to all sorts of things. Changes in trade policy, new tariffs or duties, supply chain disruptions like we saw recently, geopolitical tensions. A trade spat or instability in a key region could easily impact their orders, their shipping costs, their delivery times. It's a complex web.
Okay, we've covered a lot of internal factors and risks. Let's bring in the outside view now. How are market analysts looking at ATI Inc., considering everything we've discussed?
Well, the general sentiment among analysts seems quite positive, actually. That's a strong signal. According to Rank's data mentioned in the sources, you've got something like 17 buy ratings, only one hold, importantly, 0 sell ratings. That shows a pretty strong consensus on the positive side from the professionals who follow the stock closely.
17 buys, 1 hold, no sells. That's pretty clear. What about price targets? Where do they see the stock potentially going?
The average 12-month price target cited is around US $101.56. Now, if you compare that to where the stock has been trading recently, say in the $75 to $80 range, that suggests a potential upside of roughly 30–35%. That's quite a substantial projected return over the next year, according to that average analyst view.
And didn't they actually beat earnings expectations in the last quarter we talked about?
They did, yes. For Q2, they beat the consensus EPS estimates. Sales might have been a touch under some forecasts, but crucially, sales were still growing year over year. So that earnings beat, coupled with the sales growth, it reinforces that positive financial story we were outlining earlier.
And the credit rating agencies seem to be seeing the same positive trajectory, aligning with the analyst view.
That's right. Agencies like S&P, with that BB rating upgrade we mentioned, they've given positive assessments. It seems largely driven by ATI's improving financial metrics, better debt management, stronger cash flow, and crucially, that strategic focus on the higher value, higher margin markets like aerospace. That seems to be resonating.
Okay, just to give our listeners some context, maybe quickly list those key valuation metrics again.
Sure. So we're looking at a forward price to earnings ratio, excluding special items, around 25 to 26 times. Price to sales, based on the last 12 months, is about 2.33 times. That's what the market values each dollar of their sales at. And price to book, comparing market value to the accounting value of assets, is roughly 6 times. And yeah, as we said, while long-term debt means the total debt-to-equity ratio is still relatively high, the trend is towards improvement. That's key.
Right. So we've covered the business, the good news, the potential hurdles the analysts take. What's truly fascinating now is translating all this into, well, actionable signals. If you're considering this, what should you really be watching?
Okay, actionable signals. A few key things to keep an eye on. First, watch those profit margins. Can ATI consistently maintain or even expand them, especially when raw material costs inevitably fluctuate? That tells you a lot about their real pricing power. Second, definitely monitor their order backlog and any announcements of new contract wins, especially with the big players, Boeing, Airbus, key defense programs. Any slowdown there is a warning sign.
And the cash flow aspect is critical too, isn't it, given those large capital spending plans?
Absolutely critical. You need to track their free cash flow generation relative to their CapEx spending. Are those big investments actually generating the cash they're supposed to? Is the outlook for cash flow solid? Beyond ATI itself, you have to keep tabs on the bigger picture, macro stuff. Interest rates, inflation, fuel, costs those directly impact aerospace demand. And don't discount competitive threats. Watch for any news about new materials or technologies that could challenge ATI's position. Innovation doesn't stand still. And finally, always keep an eye on valuation. How does ATI's stock valuation look compared to its peers in the aerospace and specialty materials space? If the sector hits turbulence, a higher valuation stock can sometimes fall further.
Okay, so pulling all that together, what does this mean for you, the listener? When might investing in ATI make sense? And conversely, when might it be less appealing?
Well, look, if you're optimistic about the long-term prospects for aerospace and defense, particularly if you see continued recovery and growth in commercial air travel, then ATI is definitely positioned to capture some of that upside. It might also fit if you have a reasonable tolerance for volatility. Because companies tied to these cyclical industries, like ATI, they tend to have bigger swings in their stock price, both up and down. And generally, this probably makes more sense if your investment time frame is medium to long term, say a few years out. That gives time for those big contracts to play out, for the capacity investments to start paying back, for the free cash flow story to really develop. You need patience to ride the cycles. On the other hand, it's likely less attractive if you need steady income right now. ATI doesn't seem to be paying a dividend currently. And naturally, if you have a low tolerance for risk or market swings make you uncomfortable, or maybe you just prefer businesses that aren't quite so capital intensive, then ATI might not be the right fit for your portfolio.
So there we have it, our deep dive into ATI Inc. Clearly a company with a strong foothold in some really critical markets, showing impressive recent performance and locking in future business with key strategic deals. That's the positive side. But it's also operating in a tough neighborhood, cyclical, capital-heavy,
Oh.
facing real operational risks, and exposed to those bigger geopolitical currents. All things that need careful watching.
Exactly. And at the end of the day, the decision always comes back to you, your own investment goals, how much risk you're comfortable taking on, your financial situation. Having the knowledge is great, but it's most powerful when you apply it thoughtfully to your own circumstances.
Well said. And maybe that leaves us with one final thought for you to ponder. Given ATI is investing so heavily in its future big capex, relying on those long-term contracts, how much certainty can a company in an industry like this, inherently cyclical and capital-intensive, truly build? And what does that uncertainty mean for how you value its long-term potential? Something to think about. We hope this deep dive gives you a solid springboard for your own continued research. Thanks for joining us.